Alrighty then, key bits from day 3. Remember that technical analysis is essentially giving you a roadmap. Unfortunately, the roadmap is backwards looking. So what you're trying to do is one of 3 questions you first need to be asking yourself. What's it doing? What the market is doing? Is it trending? Is it ranging? So are we seeing this move higher? Or are we seeing a bit more range bound type trade? It's clearly got a high and a low of an area. What's it doing? How is it doing it? Is it doing a good job of it? So in this case, say you've got a trend, you've got a higher high, you've got a higher low, and these are continuing. If we start seeing a lower high, then your trend is not doing a very good job of continuing higher. That's when you've got to start questioning the move. And then are we going to see a change? And that's the third question. Is the market about to change? That's what you're trying to answer with technical analysis. They're the 3 things. And that is going to tell you where you want to be entering your trades. Now, your trades are going to come at support or resistance. All trades essentially are going to come from this. It could be short term, it could be long term. You could have it as an actual line, a level. So if the market's moved higher, come off, broken, you've got this as a level, this as a level. Or it can be from a trend line. If you start seeing continuous move higher, then you can end up with a trend line that is offering you support as well. So they're the key things that you want to be looking for when it comes to support and resistance. How you decide where it's going to come from, time frame, bigger time frame is going to give you a more important support or resistance area. Remember that support will become resistance as well generally. So the idea is that an area that would have supported the market, once it is broken, will become resistance. So for example, you see a move lower, bounces from the level, and then breaks it. Once it's broken, this level is likely to provide you resistance on any kind of move back. So they're key things to be thinking about there. Remember, bigger time frame. So if it's coming off a daily chart, think about what that means. It means that larger participants are going to be watching those areas, not just your smaller day traders who are looking at a 5-minute chart. Also, remember, it is an area, not a price. The market is very unlikely to stop at a single price consistently. So be aware of that. Depending upon your market, you know, the area could be 2 ticks, it could be 10 ticks, you know, on the more volatile markets. So be aware of that, learn your market, learn how big an area is and what it requires to actually say that the market is through an area. Now, a level also becomes weaker with time. Think about what this means. Market comes up, tests a level, tests a level, tests a level, tests a level again. It becomes weaker. Why? Because people have accumulated shorts each time it's come up. That's what stopped the market moving higher. Therefore, on a break, you've got more and more positions that are likely to get out, and that makes the level weaker. So the first time a level is tested is usually the best time to trade it. And finally, you need a close beyond the level. So whatever time frame you're looking at, you need the level to actually see a close beyond it on that time frame. So, you know, you're not looking for just, if we're looking at a candlestick, that it pokes through the level, that is not broken. You may get stopped out on the spike through because ultimately you've got to have a size of stop that you're willing to take, but it is only broken when you actually see the close up above the level. So that's the thing to remember. Where is the close? That's going to tell you, because for a larger time frame participant, someone who's a little bit more longer term, they're not going to act until they see the close. So wait until you get the close. Now, easiest way to assess conviction into levels is via your candlesticks. So you're going to have 3 types of candlesticks. Like I say, these are measuring your conviction. And you'll remember a strong conviction, Marubozu, a weaker conviction doji, so buyers and sellers can't take the market or control it one way or the other, whereas with a strong conviction candle, you have seen that the market has been driven higher. You've got an open down here, you've got a close higher, you've got no excess at the top, so there's none of that. So what is showing you is that buyers have been able to control the whole of that time frame and move the price clearly higher. Now, the size of the candle is going to matter. If it is larger than a normal candle on the day, again, that is showing greater conviction. Your next thing is any kind of rejection candle. Ultimately, all candles are going to fall into one of these patterns. Your rejection candle, what this is showing you is that selling has occurred, pushed the market lower, and then reversed itself. The sellers can't continue the move. They've run out of conviction, and that's what's driven the market back higher. So ultimately, every candle will fall into one of these categories. It is then a case of analysing where it is within the trend or within what is going on that actually will tell you a lot more about what the candle really means. For example, this rejection candle is not necessarily always a rejection of low prices. If you saw this at the top of a move, again, think about what this means. If this is the high, then what you've seen is selling that has been reversed, but the buyers have then failed to take the market any higher beyond the high. And so all of a sudden, it's actually the buyers who are in a little bit of a sticky situation because they're not getting any confirmation for their buying. Therefore, you're likely to then see a secondary reversal lower. So keep those things in mind. It is all about the context of where the market is actually going. So let's go and have a look at a few patterns. You'll remember most of these. You've got your reversal patterns. These are going to come from things like a swing rebound where you get a move higher, continues higher. You then see the move continue higher, but then close, and this is the crucial thing. You get a close back within the previous day. So this needs to be the high of the move, and then the close back inside the previous day. That's your swing rebound. Nice candlestick formation. Likewise, you could have this as a shooting star as well. If this candle was, again, shooting star, the buyers have failed on the next leg higher, and the market then starts to return and turn around. In terms of a continuation pattern that you want to be looking for, you've got the inside day. And this is basically where the market is moving from imbalanced to balanced and then back. So the market is imbalanced on this larger move higher. It is then balanced on the move lower. And then what you're looking for is a break one way or the other. This does make a lot of sense. Think about what's happened. You've seen this shift of prices. The market then consolidates to see if there's any more buyers. If the buyers do come in, your entry is going to be on the break of this high, minimum target this high, and you're looking for that continuation higher. So watch out for those inside days. Good candle pattern to be looking out for. In terms of larger patterns, so rather than just candlesticks influencing the next, think about psychology, think about what it means. So with your head and shoulders, remember you had that move higher, you then had a lower high, and the market generally should come off. Key area, the neckline, remember your entry on the break, and that's when you're looking for that move lower. Your target, the head down to the neckline. Again, double top, think about what this means. You've seen the market look for a second move higher, it's failed at the high. Once you get through this lower high, or what was a higher low, once you get through there, that confirms the move, and you're looking for a move back to the most recent swing area. So this would be your target on that double top. Two ways of playing it. You've got the aggressive move, sell the high with a tight stop on the assumption that it will be a double top, but that is essentially just assuming. You're going to need a little bit more, something else that is going to tell you something about it to perhaps sell that, or you wait for the confirmation and get in a little bit lower. Now, continuation patterns, you got your standard flag, break, and then your entry on this break. Now remember back to day 3, your stop is going to have to be below this low. You're looking for the height of the flagpole. So there are a couple of key patterns to be watching out for: continuation patterns, reversal patterns. Again, this flag type pattern could arrive in the form of more of a pennant as well. So where rather than you see just a straight downwards flag, you get this type of triangle at the highs. Again, this should theoretically break to the upside, but if you start seeing a break of this lower trend, then you do have the move down as well. So watch out for all of these patterns. Think about what it means for people though. Think about the psychology of you've got this failed additional high. Once you start breaking down, what's going to happen? All of these people who are in early on are now starting to get in trouble. So they're the ones who are going to get out as well as the market starts to come off. Now, in terms of giving you a little bit more confirmation on what level is actually going to help you out, how strong a level is, this is where your indicators come in. So first up, we have Bollinger Bands. And what you're looking for with a Bollinger Band, it tells you whether the market is likely to begin the trend or whether it has any volatility in. This area over here, you can see that they're virtually flat. What this is telling you is the market is likely to be range bound. It's not showing any signs of volatility. So again, that tells you how to adjust your trade accordingly. What you're looking for in terms of trade is any move to a steep band. So a quick move up to a steep band, you've got this move down here. Again, you've got another move down here. You're looking for that for a contrarian trade, so you're looking for it to reverse from that area. Again, think of it in terms of what it's telling you about the level. You've got this level here, these 52.92s. Test a little bit higher, but you've got that Bollinger Band. Maybe you can use it as a stop beyond it if you're selling the level, or you wait for it and it offers you the trade there. So that's what the Bollinger Bands are trying to tell you. Trades, as I say, do come off the steeper bands. Also, if you start seeing a move back within the bands, then again, that is showing you the likelihood that the volatility has subsided, and you can then start seeing a reversal. So from the outer back to the middle. That's what you're looking for your Bollinger Bands. Next up, we have a look at VWAPs. VWAP comes in to continue a trend of, it's a volume weighted average price. So what it's showing you is where most trade is taking place. If you're trading above it, then the market is quite happy to be continuing higher. Below it, then again, it's moving lower. A lot of execution or brokerage firms will use a VWAP to execute trades at. A client will ask to get a trade away above the VWAP perhaps, or at the VWAP. So you will see if the market is progressing above it, then again, you're going to see buying at the VWAP to keep the market above so that execution can take place above it or below it. In terms of a trade, what you're looking for is you're looking for a test to hold the VWAP. This is then telling you you've got to move on. We've seen an early bounce anyway, so that's telling you the market's got some strength. And you then see a test which holds and continues higher. You're then looking for subsequent tests for entries, and each entry up to a new high, so break of the previous highs on each of those entries. That's how I look to use a VWAP, more as something as a continuation tool. If you do start seeing, for example, this move back below, then you can start thinking that the trend may well be over, and you've got to then readjust what you're looking at. Final things, there's many indicators, but these are the ones that I particularly favour looking at. You've got your volume and your ATR. This is to confirm or deny a move. So what you want to see is if, say, for example, you're playing a flag, you're looking for the break. On this break higher, you are looking for increased volume. If you get the volume increasing, what that's telling you is that the market can continue higher. It's clearly bringing more people into the market. If you don't see volume increase, then of course the market is not actually doing what it's showing you. Yes, the candlestick has moved higher. Yes, it is looking a little bit like it's got some conviction, but the volume is where it is going to confirm, and this is the whole point. You need to see your moves confirmed, not just what the pattern is showing you. Again, with an ATR, the idea of this is it shows you the extent of how far the market is moving. I use a 21-day exponential. The reason for this, 21 days is the approximate number of days in a trading month. And the exponential side is to make sure that you're looking at the most recent days first, rather than going back and being influenced by perhaps a large event that happened 15 days ago. So that's where the EMA comes from. The point of the ATR is it makes a level stronger or weaker. Say you've got a move, comes down, we break lower, we consolidate, we then move back up. So you've got a clear support become resistance. Now, what the ATR is going to tell you is whether this is, or is going to tell you a likelihood of it holding. Say your ATR is 70 at the moment, and this move up is 100 ticks. What that's telling you is this level has got a little bit more strength than just the strength you were looking at from the case of it was previous support, because it will be outside the ATR. The market is unlikely, or in current conditions, the 21-day, unlikely to continue moving much beyond that. So you can sell this level with a bit more confidence, looking for a move lower. What the ATR will not tell you, however, is where the move is likely to go to. So it's not going to give you a clue on any kind of target, but it is going to confirm the strength of a level. Likewise, if in this example, this consolidation area had happened here, the break of this level would not mean quite as much, or it would become a weaker level, because of the fact you could quite easily break it, and say if that's a 20-tick move, you could still have 50 ticks left to move. So that level becomes that little bit weaker. You're likely to see a bit of a greater move. So they're the key things you want to be watching out for when it comes to technical analysis. Ultimately, remember those 3 questions. What's it doing? How's it doing it? And is it going to change? Always thinking to yourself, where is the next trade? So ultimately, that's the whole point of trading. You want to find your next trade, and those 3 questions are going to help you do so.